Now, one of the components for doing an exchange is that you must have a qualified intermediary. So when you're selling an investment piece of property, you're dealing with a lot of different individuals. You're dealing with your real estate consultant, real estate agent, you're dealing with lenders, you're dealing with the closing agent or the escrow agent, and then there's the qualified intermediary. Our role is extremely specific to the exchange. You must have a qualified intermediary in order to facilitate an exchange. So what is it we do besides giving talks? Okay, we're part of the tax code, so we're mandated through the tax code. A qualified intermediary, we're also known as an accommodator. We're either a person or a company that is going to be assigned into your contract. So we get assigned into the contract once you get onto escrow with the sale of your relinquished property. We have a written agreement that is done between us and the taxpayer doing the exchange. When we prepare the written agreement, we're going to request some information from the escrow officer or the closing attorney, depending on the state that you're closing out of. From there, we're going to prepare our exchange documents. Contained in those exchange documents are specific language. The language is important because it allows us to acquire the relinquished property. So in other words, we become the seller of the property you're selling, although we're never physically going on title to your property. Contained in our documents is going to be language about direct deeding. Direct deeding means that while we're the seller of the property, and not having to go on title, we're telling escrow or the closing attorney to deed the property directly to the buyer. So this is all contained within our exchange documents. And also the replacement property, we have to become the buyer. So again, the role of the qualified intermediary, through our exchange documents, we're going to become the buyer of the replacement property. We're also going to restrict the taxpayer from touching their funds. When I take you through the process of the exchange, you're going to understand how the money flows in a transaction. But the money has to come to the qualified intermediary. The funds that we're holding can only be used to purchase the replacement property or properties. Once you sign the exchange documents, we're now in your transaction. So our role is extremely important. You cannot do a 1031 without a qualified intermediary. I will say with a certain caveat, there are two exceptions. One is if you're doing a direct swap with the parties. So that means buyers and sellers are swapping each other's properties and the values are equal. And then another time where you don't need a qualified intermediary is if there's been eminent domain or condemnation. That's a 1033. But any other real estate transaction where you're trying to defer tax on the sale of an investment property, you must have a qualified intermediary, even if you're closing concurrently or closing within 24 to 48 hours, because of everything that we have to have. Because remember, I'm the seller, I'm the buyer as the qualified intermediary. So the exchange basically is taking place between the qualified intermediary and the taxpayer. Now, there are four basic guidelines when we're talking about doing an exchange. The property, so there's property qualification. So what kind of property are we talking about? Property must be held for trade or business or for investment. We're going to get into like kind in a little bit later. The other basic requirement is going to be, how much do I have to spend in order for me to have full tax deferral, or at least partial tax deferral? The time frame for the exchange. In other words, how long do I have to complete the exchange? You have 45 and 180 calendar days. When we get to that part, I'll explain about the extensions that we recently had, which basically after June 1st are really is no longer in effect. And then the identification rules. You have to identify the replacement property that you're looking to acquire during the time frame of the exchange. So those are your four basic requirements for doing an exchange. Now, what I'd like to talk about right now is a taxpayer's vesting. You'll hear an accommodator or qualified intermediary tell you that when you're selling a property, the same taxpayer selling has to be the same taxpayer purchasing. Now, there may be instances where the title on one property, say maybe, for example, I'm holding title in an LLC where that LLC is a single member LLC, and I am the sole member, and it's that LLC is considered disregarded. Maybe when I want to buy my replacement property, I don't want to use that LLC. Maybe I want to create another LLC, or for some reason, maybe I want to buy it in my own name, or vice versa. The key in that is that I am the same taxpayer because the LLC is disregarded. That works the same when somebody is selling a property out of their revocable living trust. That's a grantor trust, that's the pass-through trust, which I have established as for my estate planning purposes. But if I'm selling in my revocable living trust, but maybe the lender doesn't let me buy in my revocable living trust, my trust is disregarded, so I can buy in my individual name. Same taxpayer selling, same taxpayer purchasing. So keep that in mind when you're holding title to property, that even though it may not look the same, as long as the taxpayer is the same, it'll work. Now, there are a couple of instances where you might run into this, and this is very, very important. Sometimes husbands and wives may create an LLC where they're the members. If they reside in a community property state and they have elected to have that LLC be treated as disregarded, then they are the taxpayers, because you can have a multiple member LLC, husband and wife only, that can be treated as a disregarded entity. So in other words, if I'm selling in my LLC with a husband, then if I go to buy in my individual name, say because of lending issues, then I'm okay. But you have to be careful if you're creating an LLC that may be a husband and wife or multiple member LLC, then that's a regarded entity, and I've chosen to be taxed as a partnership. That's a regarded entity, and now I have to buy in that entity. I cannot buy in an individual name. There are times where I'll see individuals sell in a membership, husband and wife, held as an LLC. They have chosen to be taxed as a partnership. They're buying 1-to-4s, and there's difficulty in finding lending because some lenders will not lend to a partnership. So make sure that you're vetting all this stuff out as you're going, okay? Now let's take you through what like-kind property is. I said the first basic requirement for doing an exchange is that it has to be real property, okay? So one of the things is that what is like-kind property? Like-kind property does not mean duplex for duplex or triplex for triplex or shopping center for shopping center. As you can see by my pictures here, you can buy anything that's investment real estate has to be real property. So I can go from an apartment building to a duplex, or I can go from a shopping center to a single family residence. Very broad, very broad. The other requirements I talked about is how much do you have to invest? So we call this the exchange equation. When you're doing an exchange, the key to deferring 100% of the gain is that you need to purchase property equal to or greater than your net sale price. You must spend all of the cash and replace any existing loans. So in my example here, I'm showing a sale price of $900,000. I'm buying a replacement property of $1.2 million. The loan that I had on the relinquished property was $300,000. I'm getting a new loan of $660,000. My closing cost on my sale was $60,000. So the cash coming out was $540,000. So as you can see in this example, I put all the cash coming out of the sale into this purchase, and I received a loan so I can buy $1.2 million. Remember, I told you leverage is something that is an advantage in doing a 1031 exchange. Now, you can do partial exchanges. We'll talk about that a little bit later. But this is the goal. You're trying to buy property or properties equal to or greater than your sale price net the closing cost. So when we talk about closing costs, let me explain to you what that means. There are certain exchange transactional expenses that are considered a cost of the exchange. So here's some examples. The real estate agent commission, the title insurance premiums, escrow fees, attorney fees for closing, legal fees associated with the transaction, transfer tax, notary fees, recording fees, qualified intermediary fees. Those are all costs of transferring the property. Here are some costs that are not considered exchange costs. Prorated rents and security deposits. Prorated rents and security deposits you see typically on duplexes and multiple units. that's a cost of operating the property. So when you're crediting buyers for prorated rents and security deposits, that's going to be taxable because that's money not coming into the transaction. Other lender fees, points, that's a cost of buying money to buy the property, not a cost of transferring the property. Paying the buyer's closing costs, we see that quite often, but if I'm paying some of the buyer's closing costs, that's going to be a taxable event to me. To whatever level that's going to be, you're not going to know until you do your tax returns. Also, lender policies. Sometimes the lender is going to require additional title policy insurance. And then impounds, property taxes, and such. Those are items that are cost of operating the property or financing the property, but not a cost of selling or transferring the property. So when it comes to these issues, it's very important. Now, one of the things I'm starting to see in today's market is where lenders on certain product types may be requiring reserves. Some of those reserves can run to 12 months. Now, some lenders are allowing to look at the reserves maybe in your savings account. Some lenders are saying they want to hold back money from proceeds for that. That could end up being a boot issue when we're talking about exchanges. Don't want to get too deep into it right now. This is more of an overview, but these are things just to be on the lookout for when you're doing a 1031 transaction. Okay, so let's get into the process of the exchange. So when you list the property for sale, I think there's two people that you really need to talk to right away besides the real estate agent. One would be your tax advisor to determine whether you need to or should do an exchange based on your tax circumstances with that property and your overall tax return. And then the other party would be the qualified intermediary, somebody like me, because I'm going to tell you about the process of the exchange, what to expect, and I'll help you form questions for you to ask your tax advisor. As a qualified intermediary, we cannot give tax or legal advice, but I don't mind helping you give putting together the questions to have to propose to your tax advisor so they can determine how to answer that for you. So once you have a buyer and you're opened up escrow, then as I mentioned before, that's when we get involved in the transaction. I am going to request documents from the escrow officer. From the documents we request from escrow, we're going to prepare the exchange agreement. The exchange agreement is going to be sent to both the closing agent, the escrow officer, as well as the taxpayer doing the exchange. That's the way our company does it. You sign the exchange documents, you return the signature pages, and then we wait for the closing to take place. When the buyer brings in their money, the escrow will close, the deed will go directly to the buyer. The time frame for the exchange is now going to officially begin. You're going to have 45 calendar days from the date of closing to identify any property or properties you would like to purchase. You have an additional 135 days to complete your exchange. So the exchange period from beginning to end is 180 calendar days. Now, I mentioned that there were extensions that were granted. On April the 9th, the IRS issued a notice 2020-23, which provided individuals that were involved in an exchange with an extension. Anybody whose 45th day or 180th day fell between April 1st and July 15th had an automatic extension. Well, anybody closing after June 1st, your identification period is going to be after July 15th. So there's no benefit to the extensions for anybody closing this time right now. There were several transactions that we dealt with that the people did benefit from those extensions. But right now, there are no new extensions unless they grant them, which we're always on the lookout for. Now, you go in and you find your replacement property. We prepare the exchange documents on the buy side. When we're ready to close, we'll wire in the funds, and then the deed will go directly to the buyer, to you as the exchanger. So that's the flow of the exchange. So the exchange must be set up prior to the closing of the sale. Exchange documents must be fully executed. When you're ready to buy, we prepare the exchange documents on the buy side, and then we wire the funds in at the closing. That's the flow.